Good morning. I hope you guys are all having a good trading week. What I wanted to do with this video is basically redo an old video I had made on using Elliott Wave and kind of update it. And what this video covers is basically how to read my charts as best you possibly can. This is not necessarily a beginning video, so to speak. What I actually recommend for getting up to speed on the basics of Elliott Wave is read Prechter and Frost's The Elliott Wave Principle, which you can find on Amazon. I would start there, but if you're starting to dive in, you're new to the site, and just don't know what you're looking at, this should give you a little bit of a primer. And then as you, especially particularly, use that book to get up to speed on Elliott Wave at a little bit more detailed level, and as well, even after that, get into the webinars on our site, you'll start to see and understand how to use Elliott Wave better and better. But I wanted to give you some basic primers here for getting started. There's a few topics we're going to cover. One is I'm going to give you a warning, which is warn you about moon counts, and we'll talk about what that is. You can imagine what a moon count will be. But I want to give you some warnings on that, what to do with them, so to speak. And then second, I'm going to cover looking at a chart and considering, you may be wanting to trade, and give you some tips on considering where an entry will be. And sometimes I'll particularly call out an entry. Particularly if I'm trading it, I will call out an entry, stop, and some parameters. But I wanted to really unpack that. And then lastly, I want to just talk about technical divergence in Elliott Wave. Technical divergence is a very important technical analyst subject matter, which I won't cover in all of its entirety, but we'll talk about it very briefly in terms of things you can do to accentuate the counts, so to speak. All right. So again, first I want to talk about moon counts. And when we use moon counts, kind of an affectionate term, so to speak, not a technical term. We're talking about charts, particularly in crypto, but they show up in stocks as well, where the projections are nuts. I mean, they project to the moon, so to speak. And the first warning I want to give you is that they're really only so good as the market continuing to hold support. And to use an example, looking back in the NASDAQ.com bubble of 2000, there were many moon count projections you would have seen in lots of .com stocks that now are no more. And I have been through a couple cycles now in crypto, and we've seen them pop in altcoins, particularly in 2017. And I can say actually with 100%, every moon count I have tracked in altcoins has died. Even Ether is pretty much killed its moon count, so to speak. It has other potentials. It actually is in a state where it may rejuvenate a new one, but right now, it has killed the one we had in 2017. The only outlier I have is Bitcoin, and so I have that chart in front of you here. And I'm not really necessarily giving you the full. Well, I'll zoom out and give you the full moon count, so to speak. But what's interesting about Bitcoin is the projections we've had in 2017 so far have held. And in fact, so one of the aspects of this moon count is that if you know my work from 2017 and 18, you know that as we got into this bear market out in 2018, I said, well, for my long-term count, or moon count if you want to say, to hold, I want to make sure 3,000 holds in this bear market. And lo and behold, wave 4 there was, I think, low on BitMEX at 3125. BitMEX is the chart I use for short term, but it basically held in that 3100 region when I was calling for end of the line at 3000. So that's too close to call almost, but it worked out. All right, so and when we zoom out on Bitcoin, let me get to a weekly chart. You can see that I am there. There's actually a couple alternate counts. Let's get some data refreshed here. But I'm calling eventually for at least 500,000. I have alternates where it even goes to 3 million and whatnot, but I expect once we're finished with with this rally here, which ideally gets to 150. Let's see if it gets that far. Then we'll have a bear market. Excuse my dog. We'll have a bear market in this primary wave 4, and then primary wave 5 should reach 500,000. Now, one of the even though this count has been working, one of the warnings to give you is it actually is fairly unuseful to in cryptos to trade this length of a chart. For one reason is that it still has some really brutal bear markets, and so this bear market here, which I'm projecting is, we top at 150K, can easily get down into 10,000, 5,000. In fact, actually, I haven't calculated out new support, but the actual support for that bear market is 600. No joke. I don't think it'll get there, but it actually is the support for the primary fourth wave in Bitcoin. So you don't want to be in it basically. I mean, it may be reasonable to have some Bitcoin that you're hodling, and, maybe getting some interest or whatever through this, but you wouldn't want to have a large position. You'd want to cut back at least. And for me, I'll be cutting back like 90%, and you may even be shorting if the setups are good. So the one warning I have with moon counts, not only do they tend to invalidate in alts, but even if you're talking about Bitcoin and they're working, they still show very brutal bear markets, and you don't want to trade out this long of a chart, at least with large holding. You want to look at every chart from the perspective of where support is, and whether you can handle that support or not should determine your position size, your comfort level with staying in, and whatnot. Okay, so you have to make the math, the trader math, so to speak, which is in this situation where you are currently and where support is, and subtract that from the position. If you don't like that, cut it down. Okay, always have to do that actively. Hopefully that makes sense. All right, so that's the warning on moon counts. Now I'm actually going to give you a current moon count. We are having actually very few, show in this current bull cycle for altcoins. Actually, it's this bull cycle, if you haven't noticed, is much weaker than 2017. At least Elliott wave, it's glaring, and it's not unexpected. But Elrond is a new player, and actually that's another aspect of this bull market is the stronger ones are the new coins. And this altcoin is showing a moon count, and I'm not talking about the one that seems to be working, which is this. We had a shallow one too, and now we're running through the third, and all systems go. Actually, in fact, which we'll talk about support and resistance here in a second, but last night it dropped into a key support level, and so it's again a proving point that this count is working. Now, but when I zoom out on this count, actually get to the weekly, you can see that I have a crazy moon count that projects up to 320,000. Yes. So if this 1-2 is to fill in wave 1, wave 2, the 1-2 setup we call it, then we project out. And I'm using normal pullbacks and normal projections. They're micro. Will sometimes adjust them as we go, but often does. But this is the basic level projection in terms of our use of Elliott wave, and we get a 325,000. I highly doubt this ever plays out. I assume that there's a really strong chance actually, and I know some project lovers, people that love Elrond coin and its project and follow those white papers and all that good stuff, will say no way, this coin is a hodl forever. But I actually will be surprised if it survives wave 2. And as there's a saying I say sometimes in our webinars, wave 2s are where all coins go to die. Okay, so we'll see what happens. I mean, I have skin in the game right now, but I don't know if I'll be in the rest of it, because we'll just see how it works out. But this is a moon count. This is a great example of a moon count, and I really highly doubt we'll ever see 325,000 Elrond. It definitely would be competing with Bitcoin if it did. I'd have to look at its market cap, but I haven't calculated that out. But at least from a price per coin standpoint, it would be up there, because Bitcoin isn't projected to go past 500. Unless one of my alt counts to 3 million is in play. Okay, so that's moon counts. Again, just treat them. Don't. The main thing is don't get hung up in the projections way up here and think I'm going to get rich quick. You're going to have to trade in the part that is proving itself out. When we get down to this wave 2, we'll see setups that will suggest whether this is holding support or not, and we'll see reaction. And if we break below 18 in this situation, it's probably dead in the water. So it'll be really simple. We don't have to worry about it now, but when we get to that point, we'll have to make some decisions. Okay, so then now what I want to talk about is is entries. Okay, let's see. I have to get to a day chart on this guy. Entries. So let's zoom in, and there's a couple ways that I call out entries. And again, I will call trades if they look really good to me. I usually only call the ones out that look really good to me. That doesn't mean that they always play out, but I will pay attention. But the point here is that you can derive any entry and exit from any chart I give you as long as I put all the elements on it. And if I haven't put all the elements on it, you can ask me for them, and I may say, hey, I haven't because I don't think it looks right. But if it's valid, I'll get them on for you. It's a valid question on any chart I give. Okay, and so there are two entry styles when you look at as wave twos and wave fours. In general, in Elliott wave, we really want to trade for the wave thirds. This is the third waves. These are the waves that tend to extend, and they also tend to move the fastest. They are the longest waves in terms of Elliott wave theory, unless you have a diagonal. Well, even then, they still are the longest waves most of the time. And so you want to catch that wave too. So, but as soon as I have an identified wave one, what I do is I do a couple things. I either use a retrace tool, or I'll just pull out these ratios, and these ratios I just automatically right click and pull out ratios, and here I'm basically calling out the ratios between wave 2 and wave 1. Okay, and most of the time wave 2, this is a strange version, but usually wave 2 pulls into the 382 in a shallow wave 2, and then deep into 618 or 764, 768, or 786 area in a deep one. Okay, and this one was shallow, so this is not necessarily a great example, but this blue box. So if you see a blue box on any of my charts, I will sometimes do them in targets and for profit taking, which I should touch on pretty quickly here as well, but also put them in support areas. Okay, so I'm going to add a couple boxes here for later. We'll talk about the wave 4. All right, so so that wave 2 setup, we draw a box ahead of time. The other thing, some things I'll point out, and I don't necessarily draw it, but you can also imagine the boxes as triangles. And what the triangles are is basically reflecting on position size. So in this wave 2, and in this support area, which I've drawn in the box down to 786 retrace, this is an entry area. Okay. A stop on wave 2 you can put at the bottom of the 786, but I used to do that, and I've actually had a lot more successful trades just giving it a lot of room and putting it right at the beginning of wave 1. Wave 1 is always invalid when you break the beginning of it. That's a rule. So we can put a stop there, and then that just gives it a lot more room, and then I tighten the stop later. So that's something you can do. But those are some stop choices. But basically, you want to think of this region as a pyramid, because if you think of the width of this pyramid as representing a position size, and a lot of people use the term pyramiding as a verb, you want to have your biggest position, width of the triangle, nearest the stop. Okay? Why? Because that's where your risk is the least. If you stop out very quickly with the largest position, you minimize your risk versus getting really heavy up in the higher regions of support. Okay? The one discipline you'll have to have psychologically is that you will need to be happy with having less position with the market just takes off. And this is one situation where I actually did not get what I wanted, and I actually ended up using this supplement 1-2 and then chasing even a little bit here. So this is a tough one, but you have to accept smaller position in these situations when you end up with a shallow pullback. But it's really important, because the converse of not having that discipline is that sometimes you get a really big position in a shallow support, because the market may have trained you to expect shallow pullbacks, and then all of a sudden you get a deep one, and you're just out of luck, and you've taken too much heat, and hopefully you're not on leverage, but if you're on leverage, you may blow up. Okay, so it's an important discipline to keep your position light until you get into a deep area of support near a stop. Okay, so that's but again, you can discern this whole area by the box. Okay, I draw the box in most of these areas, and if I forget to, usually I'll pull out these ratio fibs, or you'll see the tool. So a lot of people know the fib system well enough that they can read it, and you will over time. Just take it slow. But if the entry is confusing, ask me for the region. Ask me for the stop. I'll show it to you with the box, and if it's just not good, I'll just say it, and I'll say I'll decline. I'll pass. Okay, and that's to take care of you as much as myself in terms of trades. Okay, you can take the trade anyway if you really like the coin, but I'm not going to give you parameters that are unreliable. Just not going to do that. Okay, so that's the wave two area. Okay, and the stop, and again the stop is at the bottom of wave one. If you want to be tighter, 7x4, I'll just say that will get a stop around a decent amount of time. And then finally, and again, just do the math. If you're entering a position, calculate what you're going to lose if you hit the stop, and how are you doing with that. If it's not good, then size down. Okay, now this one, wave fours are a little different. For an impulsive wave four, you don't want it to drop through the 50% of the third. Okay, so retrace. So this is the third right here. Okay, it's from 2 to 3, and I measured out the 50%. And so ideally, you don't want it to pass that 50, and if it does, it's generally not an impulse. Usually that means it's a diagonal, or worse, you get a big B wave top and they're about to tumble. Okay, so I keep the 50% stop very religiously because it's really reliable, and I do this when I'm scalping that 4 to 5 run. Okay, I love the thirds are better, but I get a lot of nice profit off 4s and 5s. And one of the reasons I do is because it's nice to have a nice land marker with the third. Sometimes price actions can be muddy in the wave 2 area, but when you have a nice third, it's there, you have that really strong move, and you tend to get a really good landmark with the 4th. So I like to scalp 4ths and 5ths. Some Elliott wave folks are out by then. They're done with the third. They're done after the third. Okay. Now, so it's 50% of the third wave. You can actually if you're using log fibs, you can actually use your own fib tool. Okay. I actually in the end of the day on a trade, I actually prefer to use the bigger 2 to current price. Okay, so this is the third, current price is right there, or current high, I should say, in the progression of the trade, and then the bigger 2. I like to use that, and you can see it gives a slightly different number, and that's a way to give room to the trade. If I was calling it the stops, I would actually call out 70 in this situation, or 69, 68. I think it showed on some exchanges today. Okay, but this is a tighter version. Actually, you can see that we held the top of the box. So I would actually just suggest using the bigger one most of the time, and I will also be putting that as a box on most of my charts, and you can use that as a stop. And again, the situation here, the stop here is just below the bottom of the box. And so we'll take off this one because I know that's being a little bit confusing. So the bottom of the box, 68 right now. Although I think we're done because we held the tighter lower degree 382 retrace. That's usually a good indication because most of the time it only gets to 382, which is for the smaller degree is actually just right there. So it hit it on the nose and then came up. And lastly, you can imagine a triangle. Gotta find my triangles. You can imagine a triangle through that region. So again, you can accumulate down into the triangle pyramid and get your largest position near the bottom of the box. Okay. So just to recap this area again, the ideal 4th wave retraces 382 of the third, but a deep wave 4, and ether is a really common deep wave 4 coin, will retrace half of the third. Okay. Again, the difference between where I'm putting this 50% is based on this 1, 2, 3, 4, 5. But I often like to give my trades a bit more room and use the larger wave 2. So I'm actually retracing. I'm counting half of this move here. Okay, it's a little bit more reliable if you want a very tight trades to use the smaller degree. Don't get me wrong, but I like to give my trades a little more room and then size down. You just have so much less stop outs, and you'll have more successful trades just as a hit ratio if you do that. You give it a bit more room and size down. Okay, so most of the time the box will actually be the way I prefer it. So I gave you an early box that was in a tighter degree, but I will wherever I put my box. And again, end of the day, the way you're using my charts is just trading box to box. It really is it comes down to that. But what you have to do is pay attention to your position size and use it well. And then lastly, as we get into the third wave, you'll start to see target boxes. So this is I actually like to take profit a little bit early, but you can now imagine where's my triangle? You can now imagine an upside down triangle where you start to scale out of a trade. Okay, so we can put a triangle here, sort of imaginary. That's about what it looks like because you kind of want to start to You kind of want to start to take profit before you get there, but when you're deep into the box, then you kind of want to find another trade. So you can imagine boxes. So we're scaling into this box and we're scaling out in that box. So that's really as easy as it is, but again, you still have a lot you have to do, which is control your position size, and you've got to do that through making some calculations. Some quick, simple addition. Okay, I have this much in, this is my price, what kind of loss do I have at a stop? Am I comfortable with that position? Size it down if you're not. Okay? All right, so that is how to use the boxes. And if there's any questions about that, throw them in the comments as we get on the site. I can run through it some more, and we can talk about it, and we can use examples. But that's the basics of it. Okay, that's the box system for the fourth waves. We don't have targets for this wave 2 because in the wave 2 we're waiting for the wave 3 to be in play, and then we have targets up. So basically you'll start to see the target boxes show once you start seeing the fourth waves show. It's pretty simple that way. And then lastly, I want to talk about technical divergence, and this is something you can sort of accentuate the trades. I'm going to say right off the bat it's a little bit hard in crypto because cryptos often have these spike lows. So here's an example of technical divergence. Let's see. I'm going to do. Let me get rid of these guys and just look at MACD real quick. I actually like RSI better for divergence, but I found this example as a very pointed example. Now, in this price action, this was a wave 1 back here, so you can see I identified the support area with the box. It was a shallow retrace. We didn't get deep in the box so far, although we did later. But here's an example of technical divergence. You can see this spike low. Okay, here we had a MACD low, and then we had a spike lower, and we had the same level basically in MACD. And then finally a spike a little bit lower, and then we had a higher MACD. That's technical divergence. Okay, so we can see area of technical divergence, and sorry it's so micro, but this is one thing you can look for in support areas. So if you're watching your chart very closely like I do, you can see a support level. You generally have to go to a smaller time frame. This is a 5-minute chart, and you want to be able to see the waves that you're trying to track. So if the MACD isn't showing you lobes where the waves are in the count, you'll have to go to a smaller time frame. So so if I went to a 1-hour chart, it would just be a mushy MACD that you wouldn't see any of these waves. You might see them in price, you wouldn't see them in MACD. Okay, but here I've got a 5-minute, so I can definitely see a MACD waves that conform in the basic shape to this, but with technical divergence. Okay, and so there's a trade there. And if you're a technical analyst, just run-of-the-mill technical analyst, you're looking for divergence all the time. You're taking trades off technical divergence. But in an Elliott wave, you're basically not looking for that divergence until you're in a support level, or maybe looking for a top. And divergence is much more pronounced in bottoms than in tops. That's another thing. So I don't even look for it at target regions. I just take some off. Okay, so that's something you can do if you're a chartist at any level. Half the time in Elliott wave, I'm trading without indicators. If the pattern is readable, the fibs do the work. And so, when I talk about some of the stop outs, sometimes a stop out is a stop run, but often the stops that I use, you end up with a diagonal. Diagonals, I won't go into the subject of diagonals, but the levels are less reliable and you have to rely on technicals. I hate trading with technicals at the end of the day. I'd rather just trade price levels. Okay, so most of the time, I'm actually ignoring technicals. But here's a little help that we can use if you're a person that's really deeply into technicals and want to accentuate Elliott wave trading. You can definitely use this technique. Okay, that's all I have. I mean, just recapping again. You're going to see moon counts, and they're actually a necessary tool for us as an Elliott wave analyst to figure out the smaller time frames, because Elliott wave, you work out to in. Okay, you work with the whole data set, and then you work in. So we may have that big broad projection, but it's not terribly useful for today's trading, but it's only useful for the analyst to get to a solution for the short time frame. Okay, so that's what we have to treat those. I get lots of asks for long-term counts, and I give it to them. I give them to people, but in reality, they're really not that tradable until we know whether a long-term support holds. Okay, like 3,000 Bitcoin in December was a very marked moment for me because it really proved out the long-term count. For now, it may break down the road, but it hasn't yet. Okay, and so when we have alt season like we have right now, we'll see lots of moon counts, and they're really basically useless. We'll see what happens at the next bear market and see if they die or live. All right, and then we talked about the use of boxes. We'll go back to that, just real quick. I mean, these are basically entry areas, areas where you can scale in and out of your trade. Okay, that's basically it. And the stops are defined. A little difference in wave twos. The stop is better at the beginning of wave one, and you should be able to see where that price started. And then in wave four, it really is below the box just slightly. And it's kind of an art. How much slightly do you want to go? On a chart like this, it would be a couple bucks for me. Like 5% a pretty reasonable room for the trade. Okay, you can give that. We could tighten up to 2% or whatever. It's just an art. Okay, and then lastly, the target boxes above. After the wave four shows, we start to see target boxes for profit taking. We'll have at one point to make about this box is we'll have several. We'll have and I would say again in this trade, since we have more fours and fives to go, I would take some principal off and then leave some profit, or you can at least take your profit off and then just add back. So you could only do partial out, partial in, partial out, and then by the time we get to the real fifth, which is way up at looks like 26.59, provided we get there, then you would take the whole thing off because that's the end of the line. Okay, when the count's finished. All right, so that's another point is you don't have when you're in third waves you don't necessarily want to take everything off, and the ultimate third wave here doesn't end until all of these fours and fives are done, and let's see, yeah, the third wave ends there, so actually just two more scales, and sorry, the wave one, not 2000, the wave one, it finishes in the 788 region, looks like. Okay, so you can take partial off and leave some on until you're finished with the count. That's a good way to trade, unless some support breaks. All right, so that's a recap. If there's any questions come up again, you can put them on the board or put them in comments on the video, and let's get trading. All right, thanks.